Hello, everybody, and welcome to VRIC Media, the most trusted voice in junior mining. We are bringing the VRIC to you each and every week with our series of expert panels. I'm very excited for the one we have lined up for you today. We've got Alasdair Macleod, publisher of the Macleod Finance Substack, and Michael Oliver, founder and CEO of Momentum Structural Analysis. This is a sequel. We did a panel about 6 months ago, and to this day, it remains one of the most popular on the channel. So it's great to have you both back. We're going to be focusing in on the gold market today. Gentlemen, great to have you back for round two.
Good to
Nice
be
to be
back.
with you.
Well, I want to talk about the fact that gold is currently knocking on the door of $3,000, a big number psychologically for investors, and perhaps a number that will cause more generalist investors to pay attention. I'm just wondering from both of your perspectives. I'll start with you, Michael, and get it from a technical perspective first, and then to you, Alasdair, from a more fundamental side of things. What stage are we at in this gold bull market?
I think gold is probably and I've been saying this for about 6 months, and so far it's started to happen, but not table banging, acceleration phase, where gold does things that none of these incremental predictions that we hear from the big banks, 3,100, 3,300, nonsense, where it suddenly leaves. And I think one of the key factors in helping it drive north in a dramatic way is simply going to be not the fundamentals that are driving gold, which are always there. It's money, okay? Never forget it. It's reality. Is the flow of money from a broken asset category, especially the U.S. stock market. I should also add the Indian stock market and the Japanese market because they're also bubbles. When that money starts to flow, it always goes somewhere. It doesn't disappear. Okay, some of it does, but a lot of it goes somewhere. And in the past, it's gone to T-bonds. It's always gone to gold. And when we didn't have gold legal, it went to home stake mining back in the 30s. So I think that's a key factor to watch now. Is not gold itself, but the breakage, the beginning breakage of the stock market, where money, smart money, says, "Hey, I got to find a safer place," and that will help goose gold.
And Alistair, how are you seeing things when it comes to the stage that we're currently at in this gold bull market?
Well, totally independently of what Michael's saying, I have to rather agree from a fundamental point of view. It's actually a very interesting juncture because I think the viewers to this broadcast will be aware that there've been huge, great premiums recently on COMEX futures over spot. And that has drawn in massive tonnages from London, Switzerland, and elsewhere into New York. Um, Now, I think the big question which we need an answer to is why is it that this has happened? As always, the answer is never one very simple effect or story. It started with the idea that Trump's tariffs were going to make it difficult for gold to go in, therefore get it in ahead of the tariffs, but the tariffs would probably push the price up 10%. Or, I mean, there might have been a little bit of that to begin with, but actually, it's rubbish. The fascinating thing about this is something which nobody, I mean, I've listened to other people. I was even listening to a broadcast by the LBMA which I think was done about 3 or 4 days ago. And there was absolutely no mention of this factor, and that is the stands to delivery on COMEX. Now, this is something which was never really meant to happen. I mean, the idea of a future, let's say, running out of its natural cycle is that you have to pin the future at that point to the spot value. So the way you do that is you say, okay, you can you can close your position in two possible ways. First way is you take the contra position. In other words, if you bought it, you then sell it and close the position out. The other way, if you have bought it, is you say, right, I want to have the underlying bullion delivered. Now, I mean, the idea is that the futures market is a credit market. It's not a physical market. And it's just a tangential point, if you like. That was always the intention. But the interesting thing is that following the COVID lockdowns, the stands for delivery have mounted and mounted and mounted. And recently it has accelerated very, very rapidly. And I extracted the figures for you. If you look at last year, 491.2 tons of gold was stood for delivery. If you look at what's happened so far this year, and we've had what, something like 18 trading sessions, 285.3 tons have stood for delivery. That is 4 times the pace of last year. In other words, this is accelerating. Now, the stands for delivery are quite complex because, you would think stand for delivery, okay, they're going to deliver my gold. No, that's not what happens at all. What happens is they try and refuse to deliver you any gold. First of all, they make it quite complicated for you to go for the stand to delivery. And, if they can lean on you and say, look, if you're going to do this, we'll never deal with you again. It's the sort of thing that they do. A guy called Rafi Faber went through this, and it's fascinating to see the process. He just detailed the whole thing. But the interesting thing is there's a guy who worked for Sprott who tried to take delivery of silver. And this is meant to be a 5-day settlement. It took 9 months for Sprott to get the silver, which they had contractually taken by standing for delivery. 9 months. Every excuse under the sun was thrown at them. And the other thing that happens in all this, and this is what emerged, is that the big bullion banks will say, look, don't worry, we've got your gold. We've got your gold. We'll give you a piece of paper which says we've got it. You don't want to pay storage fees and all the rest of it. We'll let you off that. Look, here's a piece of paper. Look, we've got your gold for you. I mean, it's a load of rubbish. Basically, this is a credit. It's a credit note for physical, which is worth literally the paper it's written off and no more. So okay, we go back to this thing where the pace of stands for delivery has accelerated. The one thing we will note is that with the delays, of people, and I think particularly on Globex, in other words, the people who are not in America using the facility of COMEX, sort of out of hours, whatever. Globex is a very big part of the gold contract. I guess that these are probably the people who are standing for delivery. Now, something has scared them to say, come on, we want our stock, for goodness sake, no more excuses. And of course, the pace at which the stands of delivery have been mounting has put the squeeze on the establishment. And not only that, but it's interesting, and here's a technical point, which I think Michael might have noticed, and that is that while, the price of gold has been rising, open interest on COMEX has been falling. I mean, it's fallen from a high, I haven't got the exact dates, but I mean, it got up to sort of just under 600,000, and it lost about 75,000 contracts on a rising price. Now, that's a bear squeeze. In other words, the establishment has been very badly squeezed. And at the other end of the telescope, you've got all these stands for delivery, people panicking. Okay, why should they panic? Well, I think there are two things which stand out to me. The first is Scott Bessent saying, we're going to set up a sovereign wealth fund and we're going to put all the Treasury's gold in the sovereign wealth fund. Okay. Now, we know that all the gold isn't there. Now, I don't have actual physical evidence, but we've got loads and loads of other evidence, circumstantial evidence, if you like, which, as far as I'm concerned, is good enough. I can't tell you how much gold is missing, but everything points to the 8,132 tons being incomplete. So the question is, from a foreigner's point of view, put yourself in the shoes of someone who's bought and stood for delivery on Globex. Is the US Treasury going to confiscate my gold to make up the difference? The answer is, better get my gold out of there. So that's the first thing. The second thing is that Trump on various occasions has said, and it's part of his Make America Great thing, he wants to get the dollar down. He wants to devalue the dollar by 10% or whatever the figure is, to make, create a nice competitive position for American industry. Now, again, if you're a foreigner, you're sitting here, you're seeing this I mean, quite honestly, maverick president, who's got absolutely no, if you like, feeling for property rights when it's somebody else's property. Talk to Gaza. How does he feel about how they feel about this? Talk to the Ukrainians who just had a demand for $500 million or something. Talk to the Greenlanders. I mean, what Trump has demonstrated is that he's very keen on his property rights, but everybody else can go hang. He wants their if he's got a right to it if he wants it. So this is creating some real strains in the bullion market. And of course, the other thing is if you look at his economic policies, they really just don't add up. I mean, of what we know about them, which again is something that maybe changed a little bit by experience. But, you sort of think, well, do I really want to be part of this? All these dollars I've got and all the rest of it, I'm better off in gold. Because the whole key point about it, and I know that, we look at gold, if you like, as an investment when it's not actually, it's money. But we analyze it as if it was an investment, which is actually what Michael's doing and everybody else does. I mean, and I'm not saying it's not valid. Of course, it is a valid way of looking at it, very much so. But actually what's happening, when the People's Bank of China buys gold, it's not buying gold, it's selling dollars. And that's the key, because what's happening is it's not gold going up so much. It's the value of currencies, which are credit, tanking. And that is the key point. When everybody realizes that it's the currency going down and not gold going up, the currency is doomed. We're a long way from there. Top people like central banks and so on and so forth have got an inkling that this is the case, which is why they're adjusting their reserves. The Asians as a whole, perhaps driven partly by political vibes, whatever, are sort of getting to the same sort of conclusion. And I think you'll find that the investment establishment, which is less than 1% exposed to gold, will gradually wake up to this, perhaps from the top down, the big boys who talk to opposite numbers in other countries, central bankers and so on and so forth. They might sort of start thinking, oh my God, we better have some of this. And then, of course, you're creating the buyers. The one way you look at it, you're creating the buyers to drive the gold price higher. But the other way to look at it, which is actually more accurate, is you're creating the sellers of credit, which will drive the value of credit down relative to real legal money. And I think what we have seen in the last 2 or 3 weeks has been a very, very important inflection point. The premiums on COMEX have gone back to normal. I mean, I was looking at it before it came out. There was only something like a $10, $12 premium on the current active contract compared with spot. Nothing. I mean, it's less than 1% equivalent of a lease rate. So we're back to normal on that. But the idea that we're back to normal and therefore the establishment can go back into the market and bang it and shake out, flaky long stops, whatever. I think that is looking quite unlikely. I really do. So interesting juncture. I think we've seen a big sea change in what's going on in the markets. And of course, the other thing, I might just add that the most important futures contract in the world is the gold futures contract. If that one runs into trouble, everything else does.
Some incredible food for thought there. Michael, I wonder if you have any comments on anything Alasdair said. Are you tracking any of those factors? And how do you kind of put all of that into your thesis when it comes to the gold sector?
Well, Alasdair always brings up issues that are sometimes outside my range of thought. And I do think beyond our technicals, but I don't include that in our work because we are focused on our unorthodox technical approach, which is the study of structural analysis of momentum trends. But one thing I've noticed in many bull markets, and in this case, Alasdair's right, it's not a bull market in gold, it's a bear market in paper assets, okay, that everything is not always an even pace from low to high. In fact, this was true in 1979 as gold had been going up for 3 years or so and suddenly went vertical. Silver went off the page vertical. The same thing in 2010 and 11. They've been going up for a decade and suddenly they launched. Okay. This time we have factors, as Alasdair's pointed out, that are far bigger, more dangerous, more collision oriented than any others we've ever seen before in modern times. This is a crisis period. Philosophically, I've always said, we're entering part 3 of Atlas Shrugged, where shit hits the fan. Okay. And I think some of the things Alasdair pointed out are, in fact, underneath the surface and will emerge and suddenly become clear. But it's always late in the game that then suddenly this awareness dawns. And that's when you get dramatic movements in markets where gold doesn't go up a couple $100 a month. It up a couple thousand in 3 month period, and suddenly launches. But it's coincident with other factors doing the opposite. He mentioned the dollar, for example, a dollar index, which is a silly method of measuring the US dollar versus other paper stuff. Specifically, about 70% of the dollar index is merely the euro and the yen. Okay, so when you look at the dollar index, you're really looking at upside down euro, upside down yen. Okay, but our technical work there shows that this factor in global markets has been dead and quiet for 2 years. In fact, if you look at the dollar index, it has been oscillating between basically 100 and 110 for 2 years now. And so let's take it in the middle, 105. So it's really been in a very narrow, non-volatile, non-trending range. And so it hasn't been a factor in upsetting things or driving things. Gold didn't care whether the dollar was breaking down. Gold left the page. In fact, since 2015, the dollar index was 97. It's now 107. So it's up 10 or so percent. Gold's up, double and a half. So it didn't care about the dollar. But when the dollar comes into play and breaks down, as I see the technicals shaping up right now, we recently got up to 110, well above 110. Now all of a sudden we're trading in the 106s. You get down on the low 104s, and our technical work says you've broken a 30-year uptrend line on momentum, not on price. You'll likely collapse the dollar down at least to 80, if not test the lows at 70. So there could be a sudden volatile activity by Forex markets that suddenly jar things in a way that they haven't for 2 years. So it's a seemingly outside factor, but it's an underlying major factor. And I think it's going to happen. The technicals look too ripe. The other one is when the stock market breaks. That's the only thing that makes the public smile right now. It's not the consumer price level. It's not anything really good, except their retirement account was up 20% last year. Oh boy. Well, if when markets top, quite often they'll shed 20% pretty quickly. I don't mean you have to crash 35% in 2 weeks, but we could easily see that kind of drop. And when you get that, all of a sudden, there's nothing else on the horizon that makes people feel happy. That's when emotion comes into play. Right now, emotion has been placated because if you look at the S&P or the NASDAQ for the last 4 months, it's been like nothing has been happening except it's a gradual, tiny little rise. You could have 2 bad days and wipe out 4 months. When that happens, suddenly you have another emotional factor enter the markets. That's when I think gold as the place to be becomes reality again to most investors. Right now, it's not. Last year, gold beat the stock market. Did they tell you that on Fox Business News or CNBC? No. The last 12 months, end of February last year, and we're almost the end of February this year. Just for example, gold is up 44%. February last year to now. Silver's up 48%, despite its seemingly lagged behavior. You wait until these other factors come into play. Forex volatility, stock market breaks. And by the way, we're already getting breakage in India, which is a bubble. It's broken its structures. Nikkei is dancing on it. We're dancing on it. And when they break, that's going to be a sudden new emotional factor and cause money to move. And that's what will drive gold in a vertical manner. Headlines or not. The headlines will come in after the fact. And you're right, the $3,000 level just might be the level at which once you exceed it, the public says, hey, I'm missing this. How come? And we think the real place to be for this year is not going to be gold, but it's going to be silver and the gold and silver miners. We think on a percentage basis, they're going to beat the pants off gold, which is typical late in a bull trend. And by the way, this bull trend, when it quote ends, I don't think you're going to have a bear in gold. I think you'll have a new reality globally as far as gold is concerned.
Well, I would like to expand on your thoughts on silver there, over the 12-month period outperforming gold. And you said you see more value in silver for this year than gold. Alasdair, I'll turn to you first, and then Michael, get your thoughts. How are you currently viewing the silver market and the potential there? And also, Alasdair, I'd really love to get your view on silver as money, because we hear so much of its use in as an industrial commodity, solar panels. It's obviously in everything. Silver is one of the most used commodities in the world. It plays that dual role, but it's not a tier one asset, hasn't been declared a tier one asset. Central banks aren't accumulating it. How do you view silver? Is it still money? And what are your thoughts on how you expect silver to perform versus gold?
Yeah, I mean, if you look at the gold silver ratio, which is just shy of 90, that's telling us it's not being priced as money at all. If it was being priced as money, you'd be, more like the Sir Isaac Newton level of 15 times. Um, I, I mean, it has some money-ness. Um, Basically, it lost its role officially, as it were, in the 1870s, particularly when Germany went on to a gold standard from a silver standard. This was following the Franco-Prussian War. And ever since then, really, silver's role as money has been as coinage. I mean, under our gold standard of 1820 through to the First World War, silver was legal tender for up to 40 shillings, which is £2. But beyond that, it wasn't legal tender. So you can see that it retained some sort of moneyness at that stage. Now, it is being priced as an industrial metal, and it's being sat on as an industrial metal. And I've long suspected that the guilty party in terms of sitting on the price of silver is actually China. China uses it as an industrial metal. It's quite simple. China wants that price not to go up because it's nice, good, healthy margins in the photovoltaic industry and so on and so forth. So I think as a major miner, China has been able to deploy physical resources, physical silver resources, to control the market. Now, I think that's probably going to come to an end. And if I'm right, and it does come to an end, then it could be explosive. I don't think I would buy silver for that particular reason. But I think what I would do is I would look at it from the point of view that with a gold silver ratio close to 90, I don't see that gold silver ratio going much higher. And not only that, but then I'm sort of like treading on Michael's territory. I look at the chart and I think, my God, this chart looks really pretty good. So it's a fascinating thing because every silver bull has been sitting on it, and they feel that it's just hasn't taken off, hasn't done what they expected. This is so boring. I mean, oh God, this is so boring. But I think when you get really bored with it and you think, oh, you throw in the towel, that's when it's really going to take off. It's just got that feeling to me that it's in that sort of technical position. I mean, as a commodity, it is really quite rare. One of the things that works against the price, of course, is it's a byproduct of mining other things like copper, nickel, and so on and so forth. And therefore, the mining industry, to a large extent, aren't really interested in the price. I mean, they just, this is a byproduct, get rid of it. Boom. We're in the copper mining business. So you can see that it's had quite a lot against it. But on the other hand, if the Silver Institute is right, it's been in deficit for the last 7 years. I mean, I thought it was 4 until I looked at the lines a bit more carefully. And the only thing that kept it together, if you like, in sort of 5 years ago was ETFs, the ETF liquidation. But I mean, it's the sort of situation where not very much ETF demand actually could change the whole landscape for silver. So again, it's rather like gold. Everybody's missed gold, in the West, that is. we sort of think, hold on a minute, with $3,000 and I haven't got any. What the hell's going on here? I better learn something about it. It's very much the same story for silver. And I think when silver gets away from this 33 level and starts looking 33 and a half, 34, I think people are going to sit up and take a lot of notice. So that's how I feel where it is at the moment. It's more a sort of technical come market feel, if you like, that rather than any sort of earth-shattering fundamental analysis.
And Michael, I know you've called silver a dog on a leash, and you think that it's perhaps going to break free at some point in the near future. Why don't you talk to us about what you're seeing there?
Yeah, it's silver and the miners in general, I think are going to beat gold. I think they're at the threshold of that breakout. Alasdair noticed that, they're dirt cheap and they don't look like they're going lower. And I think his broad assessment is dead on accurate. They're simply not going lower. Uh, I'll talk about silver first and we'll go to the miners. Silver, over the last 50 years, if you pick the highest point each year of the value of silver to gold, and we do it a different way. We divide an ounce of silver to an ounce of gold, express it as a percent. Okay. In 50 years, there was one time it was 6.5% the price of gold. It's back in the bunker hunt days. Since then, there have been multiple times that it's 2.5 to 3, but it's almost been routine that it at least gets to 2%. Well, 20 of the last 50 years, at some point, silver was 2% of the price of gold. Right now, we're 1.1 plus 1.1. Okay. If gold stood still at 3,000 and silver said, oh, I'm going to break out on the spread, and we measure it technically. In fact, we've got two trigger levels, one of which isn't far away right now. In other words, you get a couple days where silver's suddenly up 2-3% and gold's up 1. You're going to break that spread out, in which case technically it tells us, okay, silver's about to move now up toward that normal 2% level. Well, $60 silver, even if gold just sits here at 3,000 and goes to 2%. Well, obviously gold's not going to be here. If silver goes up to 60, gold will be, who knows. But if you just go to 2%, that's a massive percent gain versus gold. It's not merely less than 1%, but it's a doubling of the value of silver versus gold. And who knows if it'll stop at the routine 22% again. It might go to 2.5 or 3. Then when you go to the miners, and I sent you a chart that goes back to the 1980s, and it's a similar point we make about the miners. There are times when the miners were, and I'm using the XAU index, which is, by the way, in its front 1020 holdings has quite a few silver miners. So it is the gold silver index of miners. It's been around since the 1980s, not like GDX, which has only been around since 2006. So we use XAU here. What it shows is you divide the price of XAU into the month, each month, into the price of gold at that time. And you'll see that between the 1980s to early 2000, 2008 actually, you were living in a range above that red horizontal line, 17.5%, all the way up to 35%, just living there. Up and down, up and down. But the value level was, let's call it 25% on average over 20 years. And suddenly in 2008-9, before gold actually peaked, the miners started to break on a spread basis, performance versus gold. And they collapsed all the way down, coincident with the bear market in gold, silver, and the miners, which bottomed when? December of 2015. Well, that's when this spread made a low. That's that red arrow there. Late 2015, the spread was like 4%. Okay. So we collapsed the gold miners from 30% down to 4%. But look what's happened in the decade since. They've not lost ground. In fact, they're trading right now up around 5.5% or so. Still higher than the late 2015 low, meaning you say, well, this is a dog. Well, no, it's actually beat gold over that decade because it's higher than it was in 2015. So if you bought XAU at the bear low and bought gold, you did better owning the gold miners. Nobody notices that. But still, they're historically dirt cheap, as you can see here. And they're telling us for 10 years, I'm not going any lower, okay? The issue now is, when do they turn up? Because if you turn it up, even if you treat this spread chart just like a price chart, which in fact it is, it's price versus price, and you run up to resistance, the bottom side of that 20-year range, that's 17.5%. That's triple the current valuation of the miners. And quite often at the end of bull runs, you'll see silver and gold do something like that. But here you're already edging out over this 3-point downtrend line. And you can see we've been clustered at that black line for the last couple of years, trying to get above it, trying to get above it. And right now you're slightly above it. We run spread analysis on a closer up basis, also using GDX. And frankly, we're a hair's breadth away from breaking out over some structures that indicate it's about to begin. Same is true with silver spread versus gold. It is at 1.14, I think, something like that. You get up about 0.1% above where you are now, and it breaks out, indicating that these spreads of these the miners and the dog silver on a leash, they go with gold, but they're way behind in terms of long-term performance. They're going to break loose. I think that's going to be coincident again with the events we already talked about. External factors, seemingly. You break the stock market, you cause money flow. And I think you'll see a lot of the big asset money flow go into the big blue chip gold miners, like Newmont, for example, which have good earnings and dividends, So, and I think you'll also see a public awareness of silver again, the poor man's gold. And I think that the technicals bear that out. One, they're historically dirt cheap. Two, just to get the normal, for silver, you could double its value versus gold standing still, 1 to 2%, a huge move. I think this is about to happen technically. And I think it's probably going to be coincident with the breakage in the stock market, which, by the way, if I were to give you a time, I would say you probably are topping now. The first solid evidence will be late this month, early next, and the dramatic impact to the public will likely occur early in the next quarter. Okay. So in other words, over the next 6 to 8 weeks, you're going to see that flow and the frightened money start to move. And where are they going to move? Well, even if you're not a gold bug asset manager, you ask your guy in the back room, your technician, says, what's been doing well over the last year? The technician says, well, I told you, boss, gold's up more than the stock market. And silver's up more than the stock market. It's not 1 month phenomenon. It's been ongoing. So the asset manager says, gee, I better get into that category. Okay. And that's like, wet bar soap time. Everybody's grabbing for it. And I think we're on the edge of that right now. And I think silver will be one of the chief beneficiaries and the gold and silver miners. Even if you notice the day-to-day action over let's say the last 3 weeks, you'll notice there's a tonal difference in GDX, for example. Used to be it'd go up and they'd bang the hell out of it. Now you tend to go up and gold has a down day and silver has a down day and GDX sitting there, and it's like something's going on there. There's a tonal difference. And we think there's a technical breakout about to occur on a relative basis.
And Alasdair, do you have any thoughts on the gold and silver mining sector and also the seeming overvaluation when it comes to the broad market? Are you seeing a similar setup to what Michael's describing in that we could start to see a breakdown in this handful of tech stocks holding up the indices?
Yeah. Well, I should add, I don't sort of do any investment at all now, and I don't really follow sort of the broader markets. I confine myself more or less to well, really, I suppose credit flows, in that context. But I was a stockbroker from 1970 onwards. I can't help but think in in the terms we're discussing. The one thing I would note is that the mining sector has been out of fashion for so long. I don't think any broker has got any serious research coverage in the sector. And this is why, the few big funds who are sort of stepping into that space are buying the things where, you're not going to get sacked if it doesn't make any money, like the Newmont mines and all the rest of it. But I mean, the real money to be made is obviously going to be by those people who know the industry and who understand the geology of reserves and all the rest of it, and the language that goes with it, understands what's good management and what isn't good management, Now, none of this is really in the brokers. I mean, there are a few, specialists around, people like Rick Rule and so on and so forth, who have a pretty good grasp of this sort of stuff because they know people in the industry and all the rest of it. But it's the complete lack of research in this area, which I think is going to suddenly mean that this undervalued sector is going to find everybody rushing in at the same time trying to buy it. And as Michael said, it's bar of soap time, So it could be very, very dramatic. And of course, I mean, one of the problems you have is that when this happens, the rubbish goes up as well. You've got to be able to distinguish between the good stuff and the rubbish. And I mean, you're right. In terms of return on an investment, you're going to make a lot more money playing that game correctly than you'll ever make buying gold or silver itself. But having said that, buying gold and silver is a completely different function. You're just getting out of credit. You're still in credit if you're buying mines, because what you're doing is you're buying a management's promise to deliver value to you as a shareholder. It's a promise, it's a credit. There's a debt on one side, an obligation on one side, and you're the guy who's expecting that obligation to be fulfilled. So, that does bring in other issues. I mean, we've got a huge, great credit bubble, and it's not just confined to the markets, which Michael's mentioned, but it's general because we've had, I think, something like 6 bubbles since the mid 1980s when the banking system became financialized, and they've never been allowed to wash out. Like in the bad old days, a recession wouldn't last terribly long. I mean, you get a very deep shakeout. You get businesses which had too much debt, they go bust and all the rest of it, and a few banks probably go with it. But within 15 months, everything recovers. We haven't had that sort of environment. It hasn't been permitted. So it's all rolled up into a huge, great tsunami of credit, which is going to break on our shores. And when that happens, I mean, it's going to be very, very ugly. And obviously, it's going to particularly hit, the sort of the momentum stocks, the artificial intelligence stocks, the tech stocks, and also the things that go with them. I mean, Bitcoin correlates beautifully with the Magnificent Seven. It's the same cohort buying it. So, and that looks to me like it's topped out, just looking at the chart. I haven't analyzed it too carefully, but that I think is what we've got ahead of us. And so I would say that from an investment point of view, the sensible thing to do is to understand that you've basically got to get out of credit. But these things don't happen overnight. It could be that the credit bubble actually doesn't pop for some time, or rather like Wall Street in 1929 to 32, you have an initial shock, you've got several months of recovery, and then it's a long, long, long descent down to, it lost something like, I think, 85% top to bottom. So, it could sort of work like that. And if it does work like that, then there will be time to make good returns in the mining sector.
And Michael, I think you had some additional thoughts there.
Yeah, you said something, and then Alasdair deviated to it in a big way, and that is the financial aspect of the markets. Everybody's looking at the Magnificent Seven, and I think that that's a mistake. Yeah, I think it's a bubble. Yes, it's going to lead the downside on a percent basis, just like .com did.
Yeah.
It was an 82% drop over 2 years.
Yeah.
Nasdaq 100. It was a true reality. Internet, in fact, changed our lives in bigger ways than they even expected. Yet it was still a bubble. Yeah. 82% collapse. Okay. S&P went down 50% in that bear market. Okay. Off that subject. Right now, everybody's focused on, NVIDIA, for example. We look at all the sectors, and like healthcare, for example, is 12.5% of the S&P. We're running studies on it, long-term momentum studies, taking each month's action, measuring it versus the 3-year average, for example. Not a price chart with an overlay. That any idiot can do that. But we oscillate price. It has a structure from hell waiting right below its feet, meaning if you drop a couple points in the healthcare sector, XLV, you're going to blow a momentum floor that I've never seen one so wide and long at the 3-year average that goes back to 2011. This is the worst structure I've ever seen. When you have structures that clear on momentum and you break them, the price consequence is enormous.
Yeah.
Health, financial sector, XLF. I had nothing to do yesterday for half a day, so I ran through the top 20 stocks in XLF, top 20 holdings. And I couldn't find one that didn't look vulnerable and literally several percent away from breaking massive quarterly momentum structures. Not evident on a price chart, but evident on momentum. And one of them in particular, and I'm not going to pick on it, BlackRock, smacked me in the face. In fact, it's already starting to break its structure. I think they have some connections to Bitcoin too, but I saw of those 20 stocks, they all echoed what I see in XLF, extreme technical vulnerability for a major bear trend, but also to begin with some noise, not an incremental little, not necessarily a crash, 35% in 2 weeks, but you could easily shed 20% in a heartbeat, and then they say, oh, what a bargain, and that's just the first slab of going into hell.
Yeah.
But I see the breakage in key sectors that people aren't so focused on, and they should be, because the financial sector, because of the debt market and the high yields that have prevailed since 2022 on the long end, is choking many institutions, commercial real estate, for example, far worse than mortgage-backed securities, okay? It's sitting there ready to collapse as well, RWR, VNQ, ETFs of commercial real estate. So I think watch those sectors, because everybody's looking at NVIDIA and they're not looking at the banks again, or the brokerage firms or the asset managers. There's vulnerability there. And I think that's where I think gold knows that, tell you the truth. I think it knows that. Anyway, it's a broader situation than merely a tech bubble.
Can I add just to that? I mean, I think that's absolutely fascinating because the bank's balance sheets are very highly leveraged compared to where they would normally be historically. I mean, if you look at US bank balance sheets, I can't remember where I got the numbers from, but it looks to me as if they're round about 13, 14 times equity. That's assets to equity. Whereas, at the bottom of the bank lending cycle, they would be somewhere between 6 and 8. So these banks are very highly exposed to a collapse in the value of their collateral. And this is back to the 1930s thing. The idea, Fisher came up with this sort of theory, which is actually very, very sensible, that once the collateral starts losing value, it then starts getting liquidated by the banks, not because they don't like the collateral, it's just they need to cover their loans. And that is a self-feeding thing. So that could well happen. If you look at the Japanese banking system and the Eurozone banking system, particularly the G-SIBs, the global systemically important banks, many of those, you're looking at asset to equity ratios of 20 times. Now, a lot more than the US situation. And the reason for that is quite simple, and that is they went into negative interest rates, and the only way in which you could protect the bottom line as a bank was basically leverage out to a balance sheet. But they're still stuck with it, because the only way in which bank credit can be destroyed basically is by, on the asset side, those you've loaned money to, loan credit to, going bust. Then it gets wiped out. So that, I'm afraid, is now the only way in which the banking system can really deleverage itself. What it's doing is it's doing what the regulators want. The regulators turn around and say, well, lending money to businesses is risky. If you lend it to the government, it's zero risk. And they will look at your balance sheet accordingly. So you can see that the whole system is actually unwittingly almost being moved into the sort of situation where it's no longer fit for purpose as banks, let us say, producing credit for productive purposes. That's not happening anymore. So I'm just fascinated what you're saying about the financial sector, because, this is a sector which I think is very much in an end game. I don't know when it's going to really sort of break, but I mean, it'll be something to do with the credit bubble. I mean, once the credit bubble goes, I mean, it's the banks that will really be taken out. I mean, inevitably.
Well, gentlemen, this has been a fantastic conversation, a masterclass once again. Michael, tell us about momentum structural analysis, what it is you do there, and where people can find it.
Well, we've been doing it since 1992. We look at markets technically, but not price chart emphasis at all. But secondarily, we look at price. That's what everybody looks at. As Joe Granville once said, if it's obvious, it's obviously wrong. Okay, but sometimes it's right. But momentum is almost always, when you analyze it structurally, technically, not just is it going up big or going down big, but you actually measure it and plot it. Usually leads price in terms of making a top, making a bottom, having a correction, et cetera. And so that's what we're focused on. And we look at all four major asset categories because you can't just look at gold. You can't just look at the stock market. We're in a world now where these tectonic plates are impacting and going to impact loudly. And therefore, that's what we do, and been doing it for 33 years now.
Great. Well, I'll put a link in the description below to momentum structural analysis for people who want to check that out. Alasdair, tell us about the Macleod Finance Substack.
Yeah, I mean, I set it up a bit over a year ago, really because I've taken the view, and I really think this is terribly important, that people don't understand money, credit, and so I need to educate them. And the reason I want to educate them is so that they can understand what's happening to their money, their credit, their investments, whatever, and hopefully take some action to protect their wealth. I mean, I was doing this effectively at Gold Money, but the problem with Gold Money is that the customers of Gold Money are already converted. I'm not converting any more souls, as it were, at Gold Money. So this is why I'm concentrating on my Substack, and so I do a weekly market report. I will do at least one analysis, which might be economic, it might be geopolitical. And it's really all about educating people and trying to equip them to deal with what's going to be very, very difficult times ahead. It's as simple as that. So I'm sure you'll put a link into in on the bottom of this, so I won't repeat it.
Yeah, absolutely. Will be a link below to Macleod Finance for people who want to check that out. Thank you once again, gentlemen. It's been an honor hosting you for this conversation.
My pleasure, Jesse.
Thank you.
Thank you.